Good afternoon and welcome. I'm Chris Pizzoli. The purpose of this presentation is to provide sound investing decisions for our company based on these hard economic times with two of the leading competitors in the technology industry, namely Dell and HP. And we're going to base our analysis and our final recommendation on the stock performance and overall financial health of each company. So these companies are particularly important because, as we said, these are hard economic times. We all know this. You know it because of our company's current status, and we really need a sound financial decision and investment decision, namely. So both of these companies meet our criteria. They're both leaders in their technology industry. They both have share prices over $5, well over $5, and in 2008 their revenues were over $30 billion. So the first thing we're going to look at is the overall stock health of each company. Dell in 2008 at its peak before the recession was about $26 a share. Now that's down to about $10 a share, which is actually has recovered a bit from a bottom price of about $8 per share, and that was at the beginning of March 2009. So that's an overall loss of about 60%, so pretty significant loss there for Dell. HP, on the other hand, has lost about 31% of their shares over the last year. Where they were at $50 last year, they are now around $33, and they've actually recovered quite nicely in the last couple months, where they were at about $25 per share. So it seems that their ability to recover from hard economic times is a bit better than Dell's. And we see that by the next piece of data that I'm going to show you, the CMR index, which is the composite macro index, and what that does is it measures a company's overall exposure to the economy, which is obviously very important, especially in hard times like these. The higher the number means the more exposed the company is to the economy, and the more they can be hard hit by an economic crisis like the one we're in. Dell's CMR index number is 301, HP's 264. So as you can see, that reflects very well what's happened to both of these companies and their stock prices. HP has had higher highs and not as low of lows as Dell, and Dell has not recovered as well as HP, which is predicted by this CMR index. And finally, with the stock prices, the earnings per share are only $1.23 for Dell, and that's almost doubled by HP, which has a earnings per share of $3.19. Now, of course, as you all know, you're all executives, you're all accountants in the firm. The stock price is not the only thing. We've had many examples before of people that have come in and just said, oh, the stocks are the only thing that's important. Well, we know it's not, and it's almost ended in disaster every time. So the financial picture needs to be explored, and we're going to look at the major financial statements, the income sheet, the balance sheet, and the cash flows statement. On the income statement, we see that the revenue to expense ratio for Dell is about 1.0, meaning that pretty much all of their revenues are taken away by the expenses that they incur later on, whereas HP's ratio is 1.1, so not quite as bad there, which means they have quite a bit more operating income that they get from their revenues. And as we see in 2008, their operating income for HP was $10 billion, whereas Dell was only $3 billion. So there's quite a bit more for research and development, for example, for HP. So they're a bit more future-proof, I would say, than HP, which investment for the future is what we're all here to talk about, so very important. The balance sheet, Dell has only $26.5 billion in assets. HP quadruples that, 4 times as much assets as Dell, $113 billion. Big difference. Dell also has more long-term and short-term debt than HP, which is very important, which means HP has more money to pay dividends. Now the cash flow statement, we have the operating cash flows, which is probably the most important gauge in the overall health. HP, $14.6 billion in cash flows from operating activities. Dell only $1.8 billion. Huge discrepancy there. And also HP has better numbers. They have more negative outflow in investing, which means they have more ability to make loans and purchase assets from other companies. My final recommendation is to choose HP as the investment decision. Not only is their stock health better, their overall financial performance is better, and that guarantees that you will make more money with an investment in HP. Thank you for listening.